The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. My name is Jason Collins, and I'm with URL Insurance Group. I'm an agent support specialist here at URL, specializing in single premium life products. First off, I'd like to thank everyone for taking the time out of your busy schedule to be with us today. Those of you that are currently doing business with URL, I'd like to personally thank you. We understand that you have many options as to where you place your business. That's why we appreciate you working with URL, and we'll promise to continue our dedication to your success. Some of you are new to the URL family. Welcome. URL is a full-service national broker. We provide agents complete support in all of our lines. URL provides single premium life, fixed and indexed annuities, traditional life products, as well as individual and group health products. We also have a senior division that offers MedSup and MedAdvantage. Please take a moment after the webinar to tour our website at www.urlinsgroup.com and discover if there are any additional avenues for URL to assist with your success. Again, that website is www.urlinsgroup.com. Now, I'm extremely excited to be part of presenting this great program for you today. Hybrid life and annuity products have been growing in popularity the past few years. People, and more specifically, baby boomers, are realizing that they have cash value in old whole life policies that they don't want to continue to pay into. They have money that is set aside and earmarked for the next generation, making little or no interest, or have real concerns about their future with regards to long-term care needs. Today, we're going to discuss a few products that will help your clients with all of these concerns. I'm proud to introduce Jason Jones. Jason is the Regional Marketing Director with OneAmerica. He's here to review different annuity options that OneAmerica offers and to discuss how they will benefit your clients. Now, before I turn it over to Jason, I'd like to mention, should you have any questions during the broadcast, there is a question box on the right side of your screen, and you can type them in and we'll answer at the end of this program. So without further ado, I'd like to turn the program over to Jason.
Hey, thanks a lot, Jason. I just had to get off of mute. I'll take control of the screen here and say show my screen. So hopefully everybody can now see this screen, and I think everybody can. Well, let me echo Jason's sentiments by saying thanks again to everyone for being here. It's my pleasure and honor to spend some time with you. We've got a new relationship in the long-term care division with URL, and I'm really excited about the potential that we've got together. Today's presentation, gang, is really going to be all about how to use an annuity-based LTC option in your client's portfolio. And our goal, throughout the course of this presentation isn't necessarily to give you all the nuts and bolts of how these products work, but rather teach you some broad concepts, and so you can take those back to the practice and hopefully apply some of those concepts, and then Jason and I can help you kind of fill in some of those details as we develop cases. So we'll follow this agenda today. We're going to talk about the LTC conversation and the consequences. We'll jump into our product options, and then we'll look at some solutions as well. And as advertised, we're going to talk about our indexed annuity that's geared for LTC, also talk about a solution that allows us to convert $100,000 deposits into $1 million guaranteed for LTC. And then we'll finish up today's call with a specific solution using qualified assets to fund an asset-based LTC strategy. And, if we can do that across the course of our time together, I think we'll consider this to be wildly successful. So let's jump right in. And where we're going to start is really how to start the long-term care conversation. And I'm not going to belabor all of these starter questions that I have on the slide, but there are a handful of these that if you struggle with, how do I even broach this topic of long-term care with my clients? I know they're concerned about it, but I don't really know where to begin. Here's some good examples, and we look at this presentation to you so you can, use some of these or change them, put them in your own language. But there are two in particular that I think are absolutely critical. And I call these the two simple questions that every advisor ought to ask his or her clients. And the first one, I think, is incredibly powerful. Now, here it is. I know you may never need care, or you may never think you may need care. But if you did, how might that affect your family? And what we're doing with this question, gang, is trying to take the focus off of the client and his or her inability to perform activities of daily living, which is, of course, what long-term care is, but rather shift his or her focus onto those that he or she has brought into his life and cares about the most. So check it out. Here are four things that our clients may not have considered. I call these the consequences of being unprepared for long-term care. And the first is this, as I brought it on the slide. If you're unprepared for long-term care, there's a great chance you may wind up punishing your spouse. And what we mean by that is caring for a chronically ill person creates a chronically ill person. That's a very powerful point to make, especially with our male clients, especially with the guys. Okay? The second consequence is this. If you're unprepared for long-term care, your life doesn't end, but someone else's does. Likely your children, more specifically your daughters, even more specifically the eldest daughter, and the most specifically the eldest daughter who lives closest to you in terms of proximity. So again, especially for the guys, we want to underscore the point that if we're unprepared, it's going to have an impact on our daughters and the lifestyle that they lead. Okay? The next consequence is this. If you're unprepared for long-term care, you're going to create strife and tension in the family. If there's a family of 3 children, that is, right, and informal care is needed, odds are really, really good that they're not going to labor share that care as a third. No, one of these children is going to make the ultimate sacrifice and carry the heavy weight of informal long-term care, while the other 2 sort of sit on the sideline, kind of direct traffic from 500 and 600 miles away. Why are you doing it this way? Why are we spending this much money? These kinds of things. And that's what's going to cause the tension and strife in the family, is the interplay between the child that is carrying the burden and those that are sitting on the sideline. And that can be really generational, actually. But again, the point here is we're shifting the focus onto someone other than the person who may be failing activities of daily living. Now, the final consequence, and this is likely my favorite, if I had to pick one, which is that if you're unprepared for long-term care, you're going to encounter what I think are unnecessary losses. And here are the ones that I think are most important and likely the least understood by our clients. They're the emotional losses, the spiritual losses, the physical losses, and the relational losses, and finally, the familial losses. Now, for all of us on the call today, and especially for our clients, okay, I think we would expect us to say the financial losses are also perhaps unnecessary. And I don't disagree with that. But when we're framing up this conversation, and remember the context, right? We're trying to start this conversation, move our clients towards having a meaningful conversation about long-term care. We need to shift the focus away from the 2 things that they're likely already have been hit over the head with. The first of which is the failure of ADL and the dignity and comfort of that person, the client, and the other is the financial. Our objective with this line of questioning or this approach is to shift the focus away from those things and onto those in the family that we care about the most. And so this is the first question. And by the way, I've got a 35 to 40 minute discussion on each of these 4 points in even more detail. And if that's something that you're interested in hearing or seeing more about, just let Jason know or let me know. We can certainly get you that info. Okay, now the second question in this 2 simple questions conversation is, okay, and if you did need care, how might you go about paying for it? And you can see here on the slide, there are really only 3 choices. You can rely upon until stand, which we know is a farce for the most part, right? We could buy some type of long-term care insurance, but largely over the last 30 to 35 years, we've seen that most people aren't going to buy traditional health-based long-term care. Or, as the third option spells out, we could be a self-funder for LTC. And my favorite line I've ever heard about self-funding long-term care goes like this. By allocating nothing to long-term care, you've indeed allocated everything to long-term care. And I think that should be the mantra or the takeaway on this self-funding topic as we're discussing this with our clients. They are really taking on an enormous amount of risk by not having a strategy for long-term care. Now, how do we develop a plan for our clients? Well, we know traditionally why clients are buying health-based long-term care. It's a use it or lose it proposition. The price tag, the premium or the price tag goes up significantly over time. We've seen that even from carriers that stood on the soapbox and said, we've never raised rates. Okay? And we know that that traditional long-term care insurance plan, at least in today's financial planning environment, offers benefits that our clients don't really see value in. So the premium to benefit equation is incongruent to what our clients perceive as value. Okay? Now, let's take a quick look at asset-based long-term care. And asset-based LTC, like the products we'll discuss here in just a moment, whether it's a life insurance approach or an annuity-based approach, they have, in my mind, 3 known and positive outcomes. And by the way, that's another powerful piece of language to use with your clients. The beauty of this approach to long-term care, this asset-based approach, is there are known and positive outcomes. If you need it for care, you have dollars for that purpose. If you, as I always say, wake up an angel, you've got something going to a beneficiary. Or thirdly, if you ever change your mind, you can get some or all or your account value back. So there's a known and positive outcome. The other thing I would underscore, which is on this slide as well, is that most asset-based LTC carriers, including OneAmerica, offer premiums that can never go up in the future. So remember on the preceding slide, we talked about one of the reasons people wouldn't buy traditional long-term care insurance is that they've seen premiums jump by 30, 40, 90% in some cases. So with asset-based LTC, not only do we have 3 known and positive outcomes, but we've also got an underlying inherent guarantee that can't be found in the traditional space. Now, this is a concept slide. This is one of my favorite concept slides because I think it really illustrates the abstract version of what we're accomplishing with asset-based LTC. And what we're going to see here is the annuity-based option. So if most of our clients have ever faced with the question, which of these assets would you liquidate first if you needed long-term care, conservative, moderate, or aggressive, I think most of them would likely, at least first, turn to the conservative part of their portfolio. And in doing that, we can reallocate that asset and create these 3 known and positive outcomes. And here's how it may look. We could earmark $125,000 that we already consider to be fairly conservative, like an annuity, like cash value and life insurance, as Jason said, like CDs down at the bank, or even just cash in a money market or in a savings account. So we reallocate those dollars, and we're able to double them for long-term care. We can triple them for long-term care, or unique to OneAmerica, we can actually make those assets or that asset last their lifetime for long-term care. I'm going to take a half a step back for just a moment and just tell you that in 76% of all policies that we issue here at OneAmerica, this lifetime and unlimited rider is issued with that policy. What does that tell you or tell me about this lifetime rider? Well, really 2 things. First of all, I think this is where we're most competitive in the marketplace, which is important. But secondly, and probably more importantly, it's the lifetime and unlimited component that attracts clients to our strategy. These are clients that aren't really worried about 2 to 3 years of home care. And what they're concerned about is on average 8 to 10 years in a memory care facility because they were diagnosed with Alzheimer's. So this strategy, at least in my mind, particularly with the lifetime rider, helps us shield or protect those other assets from being consumed on long-term care. Now, there is definitely an element here of tax advantage that we've got to talk about when we're talking about annuity-based long-term care. Okay, and this Pension Protection Act, which endorses every one of our annuity-based LTC concepts, is worth spending a moment on because I think it's a real game changer in terms of how tax efficient this concept really is. So let's take an example. Upper left-hand corner of this slide. We've got an existing annuity contract that's got $125,000 in value. Now, when we dig into it, we know that this is broken down to $50,000 in basis, $75,000 in gain. And you know how annuities are taxed. Last in, first out. It's going to be taxed at ordinary income tax rate, and that's going to be taxed for every purpose. Every distribution taxed that way, whether it's for long-term care or taking a trip around the world or just paying utility. We know how annuities are taxed. Here's the advantage of the Pension Protection Act. We can 1035 exchange that existing annuity contract. It could be variable, it could be fixed, it could be an index contract. Any type of annuity can be 1035 into a OneAmerica annuity, which is endorsed with the Pension Protection Act. And every single distribution coming out for long-term care is completely income tax-free, regardless of cost basis. So here's the big idea. Let me simplify this slide for you. We can take tax-deferred annuities and make them tax-free annuities. Here's even a more succinct way of saying that. Tax-deferred to tax-free for LTC. There's an enormous opportunity with this concept. There are literally trillions of dollars locked away inside non-qualified annuities that are likely never going to get annuitized and likely just going to be left as a death benefit to a beneficiary. There is an enormous opportunity here. Now look at my next slide, which is really important, and especially the center point, the one in the middle. Annuities that are non-qualified can be endorsed with the Pension Protection Act, which is to say, we cannot deliver the same tax advantage when using qualified assets. Now, at the end of today's call, we're going to talk about qualified assets, but with this Pension Protection Act endorsement, it is very important to recognize that we're talking about non-qualified assets only. Okay, so do keep that in mind. But still, trillions of dollars in non-qualified annuities not being used for income with clients who have no protection for long-term care. I think there couldn't be, in a lot of ways, a more perfect storm, at least in my humble opinion. Okay, now check this out. Our annuity-based long-term care options are many, and we're going to talk about two of them today. We're going to talk about Annuity Care number 2, and we're going to talk about indexed annuity care, and we're going to do it in that order. Okay, 3 really great points here about the annuity portfolio for care in general, though. The first is, if we don't need the money for long-term care, it's just a regular old annuity. Okay, so that's important to recognize that the clients are still going to have tax-deferred growth. They're still going to have a 10% free withdrawal corridor if they don't, if they want to take dollars out of the contract. So it's going to be an annuity for every purpose except for long-term care. Okay, so that's point 1. Secondly, there's going to be an enhanced value when we do need it for long-term care. And that comes in a couple of different flavors, which we'll get into here in just a couple of minutes. And then thirdly, we can actually take that annuity, as we said on the concept slide, double it, triple it, quadruple it, quintuple it, or go to lifetime for LTC. So there's additional long-term care value beyond just the cash inside the policy. Now, Why do we want to use these annuity-based contracts? Well, 4 excellent points in my mind. We're going to allocate an existing asset that we don't need for income. We can take it to lifetime. We can LTC benefits will begin after just a fairly short waiting period. And finally, as we talked about, we've got these tax advantages for pension protection. Now, I want to go to another important point as well, which is that clearly having a long-term care strategy is portfolio protection for the client, without a doubt. But again, it is also portfolio protection for you as well. You know, many of us on this call today likely are asset gatherers. We're charging a fee, to manage those assets. And I need you to think about something, which is, if we've got, a ton of our clients needing long-term care in 10, 15 years, what does that do to the assets that we manage? And I certainly think that could have a pretty broad impact on the revenue that we generate in our practice. And so think about this. If you've got $100 million in assets under management, and whether that's $100 million or $50 million or 500 million, the point is not $100 million. The point is just think through this. If 70% of people 65 and older need LTC, where are those dollars going to come from? Likely coming from the portfolio that you manage. So when you think about this, this $100 million portfolio can, I think, easily be chewed up on long-term care expenses. And that's a direct impact on revenue to your practice, and it's even more direct to the income that your clients can generate in retirement. So we like to think about, long-term care and asset-based LTC being really a shield to protect not only your client's assets, but also to protect the assets that you manage as well. Yeah. Let's jump into specific product info, and we'll do that first with Annuity Care number 2. Now, Annuity Care 2, gang, is a non-qualified solution, so please keep that in mind, non-qualified dollars. Got 4 points here, the most important of which is the second one. There is a built-in rider that creates leverage. Okay, so remember I talked about going 2 times, 3 times, 4 times. That's what Annuity Care 2 is all about. We've got a built-in rider that takes our deposit and creates an extension for LTC purposes. Now, here's a great way to think about this. We've got our annuity contract on the left side of this slide. We've got the rider contract on the right-hand side of the slide. And what happens is, I bring on to the slide now, is that this rider is included in the annuity. And you can see here that there are monthly charges being deducted against the earnings of the annuity to fund or finance this rider contract. So what we see here is we can take this concept and double it, triple it, or go to, in this case, as many as 5.5 times the deposit for LTC purposes. Now, instead of looking at this in terms of months, I think it's easier to understand when looking at this in terms of dollars. So let's use a real-life case study. Here's a 70-year-old female. She's got cash money laying down at the bank that's earning, probably negative nothing or point squat, and she's going to reallocate $100,000 into this Annuity Care 2 strategy. So she drops it $100,000. We've got a total of $250,000, 2.5 times her deposit. Or we could choose a rider that gives us $400,000. There's a 4 times. Or we could take the rider, the big one, which gives us $550,000 for LTC. So when you think about this Annuity Care 2 concept, it's really a simple product strategy. We drop a certain premium into the annuity. We've got leverage for LTC, 2.5 times, 4 times, or 5.5 times the deposit. Now, I'm sure the question was begging to be asked, why wouldn't everybody just take this 5.5 times deposit? Well, here's your answer. It's age-driven. So at age 70, all 3 of these options are available. Okay? From age 71 through 75, the max leverage is the 4 times option. And then from ages 76 through age 80, the maximum leverage point is 2.5 times. So there's some age banding here, but at age 70 or younger, all 3 of these options are available: 2.5, 4 times, or 5.5 times the deposit. Now, check it out. How do we underwrite this case? Well, we're never going to ask for a paramedical exam. We're never going to look at doctor's records. We're only going to ask the client to do a 15-minute telephone interview. And in this phone call, there are 2 sections to the phone call. It's going to be medical history, which was just disclosed on the application, and it's going to be a cognitive acuity quiz. So it's going to be questions like, who's the president? What day of the week is it? Can you count forward by 3s or backwards by 2s? But this 15-minute telephone interview is, at least in my mind, one of the single most liberal sets of underwriting processes you're going to find in the business. And in fact, and I say this a bit tongue-in-cheek, but I make a pretty good living off of other carriers' decline into this product, Annuity Care too, because the threshold of underwriting is very, very low. And especially as it compares to a life insurance-based concept, there's no mortality exposure here. This is all long-term care exposure. So again, my point in sharing this underwriting slide just to let you know that this is a great place to bring cases for clients who said, hey, I'm interested in long-term care, but have been previously turned down. Because being declined for LTC insurance or any other type of insurance for that matter is not an automatic knockout to this Annuity Care 2 product. So keep that in mind. Underwriting, I think, is a distinct advantage with Annuity Care number 2. Now, here's what one of the things we put out in our advertisement to get folks to jump on the call. This is how we can take a $100,000 deposit and create a guaranteed $1 million for LTC. So here we're looking at a case where we've got a client who is 70 or younger, and we're going to use that maximum rider of 5.5 times. Okay, but we're also going to use the 5% compounded inflation protection rider that's offered with Annuity Care 2. So here's how this thing winds up working out. You can see the numbers on the right side. Okay, in the first year, our total LTC balance is not quite 5.5 times. Okay, it's actually, because of this inflation regime, it's actually about 4.6 times. Okay, but here's what happens. In the 10th year, our balance has grown to $670,000 because of this 5% compounded number. And then you can see in the 20th year, we guarantee at least $1,035,000 for LTC. And this, again, this is a $100,000 deposit. So again, you've got clients that are sitting around concerned about long-term care, may not be in the best of health, but have some cash on the sidelines, either in annuity, cash value life insurance, or again, just sitting in cash at the bank in one way or another. This could be a fantastic solution for them. Reallocate the asset, create an enormous amount of leverage, and with this inflationary rider, guarantee that in 20 years, in this example, we've got a $1 million bucket for LTC purposes. Now, check it out. Remember, with Annuity Care 2, it's a non-qualified solution, and it's endorsed by the Pension Protection Act. So let's go back to the example of 1035 exchange. So if we assume that the $100,000 in our preceding example wasn't cash, but it was a 1035, well, if we had $50,000 in cost basis, the other $50,000 is gain. Bear in mind, every dollar of tax-deferred gain will come out income tax-free. So in my mind, that is a double win from a tax perspective. You've had the beauty of tax-deferred growth over all of those years in your existing annuity policy, and now we have potentially the beauty of tax-free distributions coming out of this new Annuity Care 2 contract. I mean, if that's not a great deal, I haven't seen a great deal. And I say that also with the tongue in cheek as well. So check it out. Annuity Care 2, it's a great little package product. You're going to get 2.5, 4 times, or as much as 5.5 times your deposit. You can tie some inflation to the back end to keep that pool growing over time. It's something you want to do. And as we just discussed, Pension Protection Act endorsed, so very ripe with tax benefits as well. Now, here's some product specs. I'm not going to go through these with you. We'll get you these slides so you can, again, go through some of this stuff on your own time. But where we're going next is our indexed annuity care contract. And I want to make sure that I illustrate one very important point to you, and that is indexed annuity care is not designed to compete with other indexed annuities. In other words, we're not trying to garner market share from Allianz or American Equity or any other indexed annuity out there, quite frankly. Indexed annuity care is literally a long-term care strategy built from an indexed annuity. But it's in that order. It's long-term care first and it's annuity second. And so I want you to look through the right prism when evaluating this product, okay? Now, you see some points here. It's an index contract. It can be single or joint. You can add that rider like we talked about, double and triple when you're going to lifetime. And it's also Pension Protection Act endorsed. So, very similar in concept to Annuity Care 2. Really, the only difference is how we're going to fund this continuation of benefits rider and how the interest is going to be credited in the annuity policy. So check it out. This slide, I think, is good, but what's great on this slide is the third bullet point there. And I want to underscore this point to everybody in the call as well. There is no fee, no charge, no expense, and no spread in indexed annuity care. So when I tell you that the cap rate is, whatever, 3%, okay? It's 3%. I mean, that's the net. So no fee, no charge, no expense, no spread. It's not an MBA. It is a net 3% cap rate or 2% cap rate, whatever the cap rate is when the client funds the contract. Now, by the way, it could also be a par rate. It could also be a fixed rate if we wanted to go down that road. You could do a monthly average, do a point-to-point. And so it's not that it's just a cap rate product. The point is no fee, charge, expense, or spread inside indexed annuity care. Who are we looking for with this product? I think it's very similar to who we're looking for on Annuity Care number 2, but I want you to check this out. Indexed annuity care will issue all the way up to age 85. I've got a lot of advisors that use indexed annuity care, even though it's not the greatest indexed annuity in a sense, but for older clients in their book of business, those 80 to 85, this is a really great option for them. There are very few indexed annuities that go beyond, say, age 80. So that may be another way to use indexed annuity care. But again, primary objective being long-term care, certainly. Now, here is the same concept slide that we saw on Annuity Care 2, but here it is on indexed annuity care. Now, here's what I want you to understand. Do you see this big plus sign in the middle of our slide? I'm sure that you do. Here's the major difference between Annuity 2 and indexed annuity care. It's how we fund this rider. So remember, on Annuity Care number 2, it was a package deal. We were siphoning earnings out of the base annuity to fund the rider. That is not how indexed annuity care works. Indexed annuity care requires the client to fund their rider, either double or triple or lifetime, with an additional out-of-pocket premium. And that additional out-of-pocket premium can come in one of two ways, either with an annual ongoing premium or with a single premium. And if we do it as a single premium, we will generally solve the case this way. Hey, my client's got $50,000 that they can put into this indexed annuity care and they want lifetime long-term care. Well, Jason here at URL, he'll just work the case backwards and say, okay, we're going to break this thing out. We'll put X amount in the base annuity. We'll put Y amount into the rider. And lo and behold, we come back with $150,000 split between base and rider. Okay? So, again, big picture here on this continuation rider is double, triple, or lifetime on this product. And we can fund the rider either with annual premiums or with a single premium. By the way, a quick note about the annual premiums. The annual premiums on this product, like every product in our lineup, are non-cancelable. They're contractually guaranteed never to increase in the future, which, as we all know on the call, is starkly different than traditional long-term care, certainly. Now, check this out. This is probably one of my favorite case studies. This is a case that we wrote just shortly after we released this product. And I think it just illustrates how powerful this product can be. So look at the bottom left-hand corner. When they redesigned this slide, they sort of made the case data a little smaller. Wish they hadn't done that, but check it out. Here's an 81-year-old senior. Okay, she's in fair health. Not great health, but she is 81, but she's doing just fine. Okay, she's got a $250,000 not qualified annuity that she's not going to need for income because she's got a pension from her deceased husband. She's got R&Ds coming out of qualified assets that she frankly doesn't need to live on either. And she's got her Social Security check coming in. So this gal is sort of quote-unquote alt sex when it comes to income. But she does have concerns about long-term care, but she's really thought, and her advisor in many ways has said, that annuity you've got, it's got such a great rate on it, it's making 3% guaranteed. I would sure hate to trade that rate. So, knowing this case data, I want you to see how powerful index annuity care can be for this 81-year-old gal. So here's what we're going to do. We're going to 1035 exchange that $250,000 away from the existing carrier. When we receive it at OneAmerica, we're going to break it into two pieces. Okay, so what we're doing is funding the base contract with a certain amount of premium and the rider with the balance of that. And here's what we're going to get. We're going to deliver to this gal $85,000 per year for her lifetime if she ever requires long-term care, which is $7,000 or so per month for LTC for her lifetime. $85,000 per year for life. And mind you, it's income tax free because of the pension protection. Now, I'm not a math whiz, but on a $250,000 reallocation, $85,000 a year is someplace in the neighborhood of like 33-34% return on investment. So like in some ways, I've been saying, hey, index annuity care, it's got a 33 or 34% income rider for life that's tax-free. What? That is incredibly powerful. Now think about this. If this gal winds up needing 10 years of long-term care, which, by the way, is really not that absurd to think about. I mean, if she winds up with Alzheimer's and is in a memory care facility, remember I mentioned it earlier, the average length of stay in a memory care facility is between 8 and 10 years. And that doesn't account for assisted living or home health care prior to that point. So here's what we're saying. She's reallocated $250,000. If she needs 10 years of care, she's pulled out $853,000 out of this contract. And really, to be fair, we should probably gross that up for taxes, which is obviously dependent upon what her effective tax rate is. But, big picture, broad picture here, here's a case that I think can be unlocked using indexed annuity care. I have an older client who's not in great health, got an annuity that she's not going to use, but feels trapped because of this 3% rate guarantee. I mean, when I look at this case, I just really think that there are probably hundreds, if not thousands of clients, of advisors that are on this call today that probably have folks that fit into this category. I'm almost sure of it. Now, how does index annuity care work? A couple of other broad points about how this thing works. We're going to drop in a single premium. We can do the single life or joint life. We've got this medical underwriting, which is the exact same process as Annuity Care 2. And we're just going to credit interest based upon S&P. And again, it can be cap rate, par rate, point to point, or monthly average, or some combination of all of those things. Okay? Check this out. The middle point on this slide, probably not the middle point, the first point is, as the account value grows for LT, or as the account value grows, so does the long-term care benefit bonds. So each year the client is earning their index interest and being credited with that, their LTC benefit bucket grows correspondingly. Okay? The second point here is the multiplier effect in the annuity as well. So if we've got $100,000 in annuity cash value, there's going to be a bonus factor or a multiplier factor to give the client, say, $125,000 as the base contract for LTC purposes. And that's really on the scope of our call today. We really just wanted to underscore you got a base and a rider, you got some leverage, and there are some additional features built into the base contract. Okay? Now, how do we underwrite? Same way as Annuity Care 2. No paramed, no ATS, 15-minute telephone call. Remember, Index Annuity Care is also Pension Protection Act endorsed. So remember, on the $250,000 case we just discussed with the 81-year-old female, if that gal is bringing over in her 1035 exchange, say $100,000 in basis and $150,000 in gain, all $150,000 is going to come out of that policy completely income tax free. I mean, that alone ought to satisfy many of our clients to reallocate their annuities into this concept. Hey, tax deferred to tax free. That sounds pretty good to me. All right. If you want more resources about index annuity care, obviously contact Jason. He's got a whole host of things for you. If you want to see some things, just on our website, we've got a dedicated site for index annuity care. You can see what that is here, indexannuitycare.com. So, at your leisure, jump out there and check out some of the resources we've got for index annuity care. All right. Our last few minutes that we've got together before we take some questions and answers is shifting gears completely. And we're going to leave annuity-based LTC behind us. I now want to highlight for you our life-based contract called Asset Care. And Asset Care, gang, is a similar concept to what we've been talking about on the annuity side. We're just going to use a life chassis rather than an annuity chassis. So it's a single payable life concept. It issue all the way up to age 80. And you can fund it with cash or 1035, like-to-like 1035, or even qualified assets. And that's what we're going to focus on today. But before we jump into qualified monies, I just want to illustrate to you how Asset Care life-based LTC works. It's almost identical to the annuities we've been talking about. Okay? So here's a couple age 60. Quick word about the couple. We have a patent on joint life, second to die, life-based long-term care where there's no restriction in place for LTC benefits. And I will just say, I think we are, on the life side of things, we are optimally designed when we write it on the second death or on a joint life policy. Okay? So let me digress. Here's a couple that are 60. They're going to put $125,000 single premium into this Asset Care life product. It's going to give them a $250,000 death benefit. The full death benefit can be advanced for LTC purposes. In this case, that's giving $7,500 per month per person. So let me underscore this. On a joint case, whether it's annuity-based or this Asset Care contract, if it is a joint case, it is per month per person. So in this example, he's getting $7,500 a month, she's getting $7,500 a month. we've got $15,000 per month that we're paying. Okay? Now, on the right side of your screen, we've got the same continuation of benefits rider that is added with an additional premium. So this looks a little more like indexed annuity care in terms of how the rider is funded. Now, you can double the death benefit for long-term care. You see that as the top option. Or you can go to lifetime and unlimited. And remember, 76% of the business we write has lifetime tied to it. Okay? Now, the annual premium for these two 60-year-olds to buy lifetime long-term care at $7,500 per month per person is $2,305 a year. Remember, this annual premium can never increase either. It is non-cancelable. So think about this. We shift over to $125,000. We've got, coming back to our kids, if we never need care, $250,000, tax-free because it's life insurance. But if we did need care, by funding about $200 a month, not even $200 a month, we now have a lifetime of unlimited long-term care for the both of us. I mean, gang, that is an incredible concept. Incredible. And we do this on a joint life basis. I think that's just, I think that is a fantastic option. Now, let's talk about qualified assets. Let's talk about qualified assets in our last few minutes before Q&A. So we know that not only are there many of our clients who have a disproportionate amount of their wealth held in qualified money, we know that there are still those folks who likely won't need their qualified dollars to live on in retirement. And when they get to R&D age, they say things like, you know, I wish I didn't have to take my R&D because I really don't need the money. And I certainly don't want to pay the taxes. Now, those same clients that I've described to you, many of them have no solution for long-term care either. Here's a way that we can use qualified assets to fund a life-based long-term care solution in one concept. So check it out. Here's what we're going to do. We're going to show a quick little visual. And this visual is that of an hourglass. So here's what I want you to think about and know. Our product name for qualified dollars is called Asset Care Number 3. Asset Care Number 3 is actually two policies packaged together. It's an IRA, which is going to be represented at the top of this hourglass, and it's a 20-pay life-based long-term care policy, which is represented as the bottom of this hourglass. So let's walk through how this package design, two products working together, uses qualified assets to fund this concept. So here's how we go. We're going to go trustee to trustee with $125,000 in this example. Now clearly, trustee to trustee is tax-free. Okay, so that $125,000 is going to hit OneAmerica and go into an IRA that's paying a guaranteed minimum of 3%. Okay, the top of the hourglass is an IRA with a guaranteed minimum of 3%. Now, we are going to connect the new IRA to the 20-pay life policy. And when we do that connection, we're actually taking a distribution. And in this example, the distribution is about $8,000. So follow me through this example. We brought in $125,000. We took $8,000 out. At the end of the first contract year, we're left with a balance in the IRA of $117,487. Okay? We add to that the value of the life insurance death benefit, which in this case is $133,000. And we've got a total base policy amount, you guessed it, of $250,000. That $250,000, gang, is just made up of IRA, the remaining balance of the IRA, and the 20-pay life contract. So you add 117 to 133, you get 250,000. So we're back to the slide 2 or 3 ago, which we said, hey, We drop in 125,000. We got 250 in our death benefit. We've got the ability to generate, again in this example, 7,500 per month per person. And remember, we can still buy that lifetime and unlimited rider on the back end of this Asset Care 3 contract as well. Now, a couple of quick points of clarity, all right? The first point of clarity is this. If you're ever given the choice of using qualified assets or non-qualified assets, we would almost always choose using non-qualified money. It's just easier, it's cleaner, there are more tax benefits. So keep that in mind, all right? That's first. Secondly, this $8,000 distribution that is connecting the new IRA to the 20K life policy, that's a taxable distribution. I mean, it has to be. It's a distribution coming out of an IRA. There's no other way to classify that other than ordinary income, period. All right? So that's second. Thirdly, this $8,000 distribution will satisfy and help satisfy required minimum distribution. So now we guarantee that on the $125,000, we'll fully satisfy the R&D there. But it's just a distribution, which means if there are other qualified assets elsewhere, that $8,000 will count towards any larger R&D that the client needs, that the client needs to satisfy, right? That's certain. Fourth, if this client never winds up needing long-term care, and let's hope that they don't, okay? Here's what has happened over time. The value of the IRA has been depleting because we're taking this $8,000 distribution. However, as you see on the slide, the value of the life insurance death benefit has been increasing. So here's the point. If these folks never wind up needing LTC, we have just taken $125,000 fully taxable asset and converted it into a 100% income tax-free death benefit of $250,000. Because over time, our goal, the objective is to slowly liquidate this $125,000 IRA while slowly increasing the death benefit on the life side. So you're probably wondering, okay, how does this hourglass thing sort of play into it other than it looks nice on a slide? Let me tie this all together for you. There is always $250,000 of benefit inside this hourglass. On day one, it's broken into about $117,133. Someplace down the road, it's going to be $50,000 in IRA and $200,000 in life death benefit. And at the end of the road, it's going to be a zero in IRA and $250,000 life insurance death benefit. So let me give you one more corny little thing to remember this problem. Okay? There's always 1 hour worth of sand inside of an hourglass. That's why we call it an hourglass. Otherwise, we call it a 45-minute glass, right? So make the connection to Asset Care 3. There's always about $250,000 in benefits inside this hourglass. Just a matter of how much sand, or in our case, how much of the IRA has been dripped into or sifted into the 20K life policy. Okay? Now, we underwrite the Asset Care contract in a different way than we do the annuities. We're still going to start with a telephone review, but we may need paramedical exams and a review of doctor's records on the Asset Care life product. Okay? So while it's still going to be streamlined and expedited on Asset Care, we do have to go through parameds and ETS. Now, big picture, again, this tongue-in-cheek, but if you've got someone who's been turned down by another life-based LTC carrier, think about us. Because we can do parameds and look at doctor's records, we have the highest placement rate in this life and annuity-based LTC business. And it's not because we take on more risk, it's because we're willing to go the whole 9 yards and do a paramed and look at doctor's records if we need to get paid for it. Okay? So another quick word, which I should have started with, which is on when we talked about the life product, for those of you that write primarily in Pennsylvania, the life product is not available jointly in Pennsylvania. Okay. Now, if you got clients outside of Pennsylvania, you can do this contract as joint. So basically, we've got a joint life solution every place except Pennsylvania. Now, the other point of clarity is on this joint life issue, all of the annuities we talked about are available as joint life even in Pennsylvania. Okay, but the Asset Care Life product is also a dynamite single life story as well, even though the example that we first looked at was a joint life example. Okay, so we want to get started. What are you going to do? Well, you can pick up the phone, call our sales desk. You can send us a quick email to get an illustration. But what I really think you ought to do is, reach out to Jason and your partners at URL. You are in great hands with these folks, and we really appreciate the partnership that we've begun with URL. And Jason, I want to thank you again for allowing me to do this presentation. And if there are any questions, we can take those now, or we can give people back 5 minutes from their day.
Yeah, we do have a few questions here. Let me expand this out so I can make this nice and easy for myself to read. I want to thank you, first of all, for a great and informative presentation. One of the questions here is, could a client who's currently undergoing cancer treatment qualify for Annuity Care number 2?
Great question, and the answer, unfortunately, is no. So with the annuity-based concept, there are a handful of knockout questions, all right? And let me share some of those with you. The first is that you're under any type of doctor's care, including, say, in this example, maybe chemotherapy or something like that. Okay, so that's a knockout. Another knockout would be like AIDS, Alzheimer's, Parkinson's, MS. Okay. Another knockout on the annuity side would be that you're using a wheelchair or a walker or oxygen or you're on dialysis. Okay. Now, here's the good news for whomever asked that question about the cancer. Our window for most cancers, 2 years from the last date of treatment. So when this client of yours, gets about 24 months under his or her belt, we can immediately consider them for the annuity-based concept. But unfortunately, if you're currently undergoing any sort of medical treatment for cancer or really for any reason, we can't consider it. That's a good question.
Okay, I got another question here, Jason. It says, does Annuity Care number 2 make sense for very healthy clients who can easily pass underwriting? Would life-based LTC make more sense for them?
So this is, and I've been representing these products for almost 12 years now. OneAmerica has been offering these products since 1989. And I've got to, I developed my own opinions over time. Here's my philosophy. If our clients can get underwritten and approved for life-based long-term care, I generally think that that's a better solution. So if you wanted to do a comparison, and I'll just make this as simple as possible, okay? If I've got a 60-year-old client who's going to put $100,000 into Annuity Care number 2, right? I'm going to get her, whatever, $4,200 a month. If I use the 2.5 times leverage feature, I'm going to get her, 5 years of coverage at $4,200, which, really isn't that bad. It's actually good. But that same 60-year-old client, if she came to my life-based long-term care concept, I can probably get her that same $4,200 a month, but for her lifetime. And I can deliver an income tax-free death benefit out of the life contract, where if she has an annuity policy, there's going to be some income tax to pay from some, the beneficiaries have to pay some income tax at that. So, that's a loaded question, and I appreciate whoever asked it. But I would generally say life-based LTC is probably my first choice. I would go to annuity-based concept in one of 3 scenarios. Okay, the first is the client's a little older. Secondly, the client's not as healthy. Or thirdly, we could have a very young, very healthy client who wanted to 1035 exchange an existing annuity and use those funds as the LTC asset, in that case, then absolutely you go to the annuity because you're older, you're less healthy, or you have a 1035. But if everything else were equal, then you're, you're 60 to 75, you're in pretty doggone good health, even fair health, and you're just going to use cash, then I think the life-based option makes more sense. And that's just my opinion. It's all case by case.
Okay. One final question here. Can annual premiums be is the only way to fund these, or are you able to do a flexible with a 5 or 10 pay?
Okay, so let's talk a little bit about funding. So the annuity-based options are going to be single premium strategies for the most part. Now, you can buy that continuation of benefits rider on an index product, with an annual premium, but it's still going to require a lump sum or a single premium up front. So let's just consider all the annuity-based options to be basically single premium. Now, on the life side, we talked about this IRA strategy. We talked a little bit about just cash, but on the life side, we can do the life product as an all pay. We can actually do just monthly premiums to fund both the life insurance element and the continuation of benefits element. We do have some short pay options on the life side as well, 10 pay, 15 pay, 20 pay. So we have a little more flexibility on the life insurance side in terms of how we fund the contracts. But generally speaking, annuities are going to be single pay. The life side is going to be a little more flexible.
Okay, that's great. Well, that's all the questions. I want to thank everyone for joining our presentation today. Everyone who registered will receive a copy of this presentation in your email rather. So please feel free to give us a call at URL for all your single premium life and annuity needs. Should it be brochures, illustrations, or simply answers to your questions, our toll-free number is 1-800-926-8875. Again, my name is Jason Collins. I'm at extension 156. You can also ask for Joe Corio at extension 111 or Maria Adams at extension 102. Thanks, everyone. Have a wonderful day.